In July 1944, while the war still raged, 730 delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. Over 3 weeks, they designed a new monetary order to replace the chaos of the 1930s, and they signed the final act on July 22, 1944. The conference created the International Monetary Fund to monitor exchange rates and lend to deficit nations, and the International Bank for Reconstruction and Development that became the World Bank. The goal was simple: never again the competitive devaluations and trade barriers that had deepened the Great Depression. Two men shaped the blueprint. John Maynard Keynes, advising the British Treasury, wanted a global central bank called the Clearing Union that would issue a new international currency, the banker. Harry Dexter White, the U.S. Treasury's chief international economist, wanted something smaller, a stabilization fund built from national currencies and gold, with no new money invented. Because the United States held the financial leverage, the adopted plan resembled White's, with the fund's resources raised from $5 billion to $8.5 billion as a concession to Keynes. The mechanism was elegant and fragile at the same time. Every member fixed its currency to the US dollar, adjustable only within a 1% band, and the dollar alone was fixed to gold at $35 an ounce. Other nations held dollars as reserves and could redeem them at the US Treasury for gold. That made the dollar the world's reserve currency and placed the entire system's credibility on a single promise: that America would always honor $35 an ounce. That number was not new in 1944. It came from the Gold Reserve Act that Franklin Roosevelt signed on January 30th, 1934, which transferred all monetary gold to the Treasury and reset the price from $20.67 to $35 an ounce, devaluing the dollar to 59% of its old parity. The IMF formally came into existence in December 1945 when its first 29 members signed the Articles of Agreement, after Congress passed the Bretton Woods Agreements Act in July 1945. But the full system did not switch on until 1958, when European nations finally lifted exchange controls and their currencies became convertible. At the start, it looked unbreakable. The United States held about 3/4 of the world's official gold, with reserves peaking near $24 to $25 billion in August 1949. But economist Robert Triffin spotted a trap. He testified to Congress in 1959 and published Gold and the Dollar Crisis in 1960, warning that to supply the world with dollars, America had to run permanent balance of payments deficits, and those same deficits would eventually pile up more dollars abroad than there was gold to redeem them. Some later economists argued the dilemma was overstated and that policy choices, not an inescapable trap, broke the system, but the pressure Triffin described was real and growing. The strain stopped being theory and became arithmetic. By 1959, the U.S. gold stock equaled total external dollar liabilities, and a run in the London market pushed gold to $40 an ounce on October 20th, 1960. By 1961, outstanding dollar claims began to exceed the U.S. gold stock, and by 1964, the dollars held by foreign governments alone surpassed all the gold in American vaults. From that point, redeeming every foreign dollar at $35 an ounce was no longer possible even in principle, and every dollar holder had a reason to convert to gold before everyone else did. Washington and its allies improvised a series of dams. In March 1961, the Treasury's Exchange Stabilization Fund intervened in currency markets for the first time since the war. And from March 1962, the Federal Reserve opened swap lines with foreign central banks, growing to 9 partners and up to $900 million. On November 1st, 1961, 8 central banks formed the London Gold Pool to hold the price at $35 by selling gold into the market. These measures bought time, but they corrected nothing. Not everyone wanted to prop up the dollar. On February 4th, 1965, French President Charles de Gaulle publicly attacked what his finance minister circle had named the dollar's exorbitant privilege, and announced France would convert its dollar reserves into American gold at the official rate. Advised by economist Jacques Rueff, de Gaulle repatriated French gold from New York and London between 1963 and 1966, then pulled France out of the gold pool before it failed. It was the first major power to openly bet against the system. Then came the spending. Vietnam War costs and Lyndon Johnson's Great Society program swelled the deficit, and an increasingly accommodative Federal Reserve let inflation run. Together they pushed U.S. inflation from under 2% in early 1965 to 6% by the end of 1969. Confidence cracked, and after the British pound was devalued in November 1967, gold ran hard. Between December 1967 and March 1968, the gold pool lost about $3 billion in gold, nearly 1,000 tons in a single week, and it was disbanded on March 17th, 1968, replaced by a two-tier market where central banks traded at $35 while the private price floated free. By the late 1960s, the imbalance was overwhelming. Foreign-held dollars approached 50 billion while U.S. gold reserves had shrunk to about 10 billion, falling from roughly 20,000 tons in 1950 toward under 9,000 by 1971. On the official settlements measure, the balance of payments deficit ballooned from about $9 billion in 1970 toward around 30 billion by August 1971. The U.S. trade balance turned negative in April 1971. And in early May 1971, Germany suspended dollar buying and let the Deutschmark float. Special drawing rights, the IMF's so-called paper gold created in 1969 and activated in 1970, arrived too little and too late. In the summer of 1971, the dam gave way. Treasury Secretary John Connally, who had argued that foreigners were out to screw America and the job was to screw them first, had in hand a May Treasury study concluding the dollar was overvalued by 10 to 15%. Speculation exploded the week of August 9th, with central banks intervening to the tune of about $3.7 billion to hold their currencies down. In mid-August, a garbled British request to cover roughly $3 billion of its dollar holdings was heard as a demand to swap $3 billion for American gold. In his own memoir, Paul Volcker later wrote that this request did not trigger the decision, and that the momentum toward it was by then unstoppable, but it showed the run was real. From August 13th to 15, 1971, Nixon and about 15 advisors met in secret at Camp David, among them Connally, Volcker, and Fed Chairman Arthur Burns, who opposed closing the gold window and found no support. On the evening of Sunday, August 15th, Nixon went on national television to announce his new economic policy. He suspended the dollar's convertibility into gold, froze wages and prices for 90 days in the first peacetime controls in U.S. history, and slapped a 10% surcharge on imports to force trading partners to revalue. He called the gold suspension temporary. In one stroke, the international system had become a fiat money system. The world tried to glue the pieces back together. At the Smithsonian Institution in December 1971, the Group of 10, chaired by Connally, devalued the dollar to $38 an ounce, about 8.5%, with other currencies revalued for a net average near 10.7%, and Nixon called it the most significant monetary agreement in history. It lasted about 15 months. Gold ran to about $60 by mid-1972 and $90 by early 1973. A further devaluation to $42 on February 12, 1973, failed to hold, and by March 1973, the major currencies were floating. Bretton Woods was finished, and the modern fiat era had begun. It is tempting to say that going off gold caused the Great Inflation, but the truth is more layered. Inflation had already begun climbing in the mid-1960s, while the gold link still nominally held because the external discipline that gold once imposed had effectively stopped restraining U.S. policy years earlier. What 1971 removed was the last formal anchor. With that gone, and with the Fed under Arthur Burns running accommodative policy, the inflation already underway worsened. U.S. consumer inflation rose from 3.3% in 1972 to 11.1% in 1974, fed by the dollar devaluations, the 1973 oil embargo that quadrupled crude from $2.90 to $11.65 a barrel, the lapse of wage controls, and the 1979 oil shock. It peaked at 13.5% in 1980, near 15% in March 1980. Most economists today attribute the episode primarily to monetary policy errors, rather than to the absence of gold alone. The inflation was only broken when Paul Volcker, as Fed chairman, drove interest rates toward 20%, and the economy fell into the brutal recession of 1981 to 1982, with unemployment hitting 10.8%. That sequence is telling. The cure for the Great Inflation was monetary, which is the strongest clue that monetary policy, not the mere absence of gold, was its central cause. What replaced the gold anchor was the credibility of central banks, and eventually formal inflation targets. The shift of 1971 is not just history, it is the framework your savings live under right now. Since the dollar was cut from gold, it has lost roughly 88% of its purchasing power, with cumulative inflation of about 722%. So in 1970, $1 buys what $8.22 buys today, an average of nearly 4% a year. Under a fiat system, money is anchored not by metal but by the discipline of the institutions that issue it. Historically, cash left idle has lost purchasing power year after year, which is simply how inflation works in the world the story created.